Welcome to the world of real estate investment, a cornerstone of a diversified portfolio that offers long-term returns and tax benefits. But what do you need to know to get started? First, let's demystify some jargon. REITs, or real estate investment trusts, pool investors' money to buy and manage income-producing properties. Zoning classifies properties as categories like residential or commercial, dictating their use. Income-producing properties are assets that generate revenue, often through renting. Now, why invest in real estate? It offers long-term financial stability. Whether you're eyeing rental properties, commercial spaces, or even digital real estate, the sector is ripe for financial growth. But success is not accidental. It requires understanding market trends, zoning laws, and investment strategies. And watch out for red flags. Property condition, location, and market trends can make or break your investment. This is your foundational guide, equipping you with the essential tools to navigate the real estate landscape. So, Crystal, I'm wondering if you can kick us off, because given your diverse background, how is it that you got started in real estate? And what advice would you give to people that have multiple interests like you do?
I would say you start with the basics and the fundamentals. Because even for me, my first property, it seems like sometimes the time picks you. You really have to surround yourself with people who know what they're doing, know what they're talking about, and can really guide you. Because no matter what the market's doing, you need a budget. That's the number one top thing you need. So interest rates are high, interest rates are low, this, that. None of that matters if you don't have a budget. I bought my first place. It was by accident. The landlords of the place that I grew up in on the south side of Chicago, they were selling the place, and at the time, I was making $14 per hour also. And I had friends that went to real estate meetings. So I was like, hey, can I go with you to your real estate meeting? I just wanted to meet someone and tell them, hey, buy this place. That's a really great deal. It was a duplex. My mom lived in one unit. I just didn't want them to raise my mom's rent. And they were like, well, if you have a job, you can buy it. And I was like, shut up. And they were like, yes, girl, you can buy the property if you have a job. So, interest rates were 7.5% at the time. But when I did the math, buying that duplex, and coupled with what the portion that the other tenant was already paying, that equaled a cheaper rent that I was already paying. So once you break it down and do the math, hey, it made financial sense for me. So people are afraid right now because interest rates are 7.5%. But if that's in your budget and you find a great deal, just let the numbers tell you what to do. Don't let, the market trends and jumping on or off a trend. Always do what is comfortable with you and what works in your numbers, because investing in something, the one you don't understand, you will lose and you will regret it. So make sure you understand everything and, go within your comfort zone and go within your budget.
That's incredible. That's an incredible start. Eric, can you maybe give us, explain the concept of house hacking for beginners, and how can it serve as an entry point for somebody wanting to getting into real estate investing?
Yeah, totally. First off, Crystal, I agree with everything that you said. I feel like there's a lot of people that are just following along the news trends, seeing super high interest rates, and immediately kind of saying, hey, we can't do this. But it's always about the deal. And up markets, down markets, there's always deals to be found. In terms of house hacking, I feel like there's something daunting about that terminology, house hacking. And I've had people come to some meetups where they're like, oh man, how do I get into house hacking? But at its core, it's just you buy a place and then you rent out parts of it. That's as simple as it gets. So for us, we were primarily looking for places that had either ADUs or looking for multifamily properties. We lived out of ADUs and then rented out or Airbnb'd out the main house. So the way this works, like Crystal was saying, is if you know what your costs are going to be, your mortgage, your CapEx, OpEx, all of those things added together, and you know that you're going to be able to make at least that amount of income, you can live rent free. And there's nothing better than not having a living expense that you need to pay for anymore. I think once that clicked and once the first property worked out that way for us, it was just a no-brainer to just go all in onto real estate.
ADU is
yes,
accessory dwelling unit?
Yes, accessory dwelling unit.
Yes, I
There
get
you go.
points. I get a star. Rich, can you talk about, because you got started when you were not living close to
Right.
Alabama.
That's right.
So what are the principles that you had to adhere to when you got started?
I guess if you know when you hear my story, I actually, when it comes to investing in Alabama, I did get a start here. And this is something that a lot of military members are able to do. And that is, we move in my case, I moved every 1 to 3 years for 20 years. One of my locations in 2013 happened to be Montgomery, Alabama, but that was just going to be for 10 months. And I came here pretty upset, like, oh, Montgomery, Alabama, like what is there going to be to do there? I definitely can't invest there. But once I got here and got to know some fellow military members who were killing it in real estate, I was like, well, wait a second, where are you buying houses? How much you paying for them? Like, what's the rent? Okay, wait, property manager, like contractors? And I figured all that out. And I started very rapidly buying houses. Now, not everybody's in a position to very rapidly buy houses, but this is at the 13-year point of my military career. And I've been trying to do real estate for 13 years. And I've been saving up money and I've been investing well in all these different things. So it just kind of culminated to where that was possible. But in my case, I sort of set up systems while I lived there for 10 months, set up everything I would need, knowing that I knew I'd leave the state, but maybe the country. And I'd set it up so that I could continue investing and continue buying once I was gone.
Talk about that differential in cost, because I think before Alabama, you had bought like a house or property in Washington, D.C.
Yeah.
And that was like the screaming opportunity for you, like your intro to Alabama.
Well, I think it was very interesting because I had a townhouse that I bought. I remember I bought it for $280,000 in 2003. I thought it was the worst mistake of my life. I thought I was overpaying. Obviously, those numbers don't seem too bad right now. When I got to Montgomery, Alabama, I realized that I could buy houses here that were going to rent for $800, $900, $1,000 a month. I could buy them. Back then, I was buying stuff for $30,000, $40,000, $50,000. Before I got to Montgomery, Alabama, I had been flipping houses in DC, and I was using mortgages to buy these houses. So I was buying houses in Alabama for less than half the price of my down payment on my flips in DC. So that was like a huge eye opener for me.
That is crazy. I mean, I know that the prices have gone up since you first started, but yeah, back then it's like, do I want to buy a car or do I want to buy a house?
Yeah. Yeah. So, and I mean, prices have gone up a lot. And of course, when I bought a house for $30,000, it needed a lot of work. But I mean, if you've heard of the 1% rule, and there's this rule that real estate investors sometimes use, if you say buy a property for $100,000, as long as it rents for 1% of that per month or more, it might be a good investment. That's hard to come by. It's always been hard to come by, but it's almost impossible to come by these days. That was an easy rule to meet in Montgomery, Alabama, when I showed up in 2013. We were buying stuff off the MLS rent ready for the 1% rule. So, which basically means like, if you can buy for $100,000, it rents for $1,000 a month. So I was buying as fast as I could.
And it's incredible that you could purchase multiple properties and do so debt free.
Yeah, and I think obviously that's unusual. I know for me, like I was kind of a Dave Ramsey fan in the past, and I was definitely like a no debt person way back in the day. And I had my primary residence paid off in DC, and that was a rental, so it was cash flowing. It wasn't cash flowing great because it's a high cost of living area, and it just wasn't. So when I ran out of money to buy houses in Montgomery, Alabama, I sold that house. I sold my primary residence in DC. And that allowed me to buy, I can't think of the number, but 8 more houses, I think, for cash. So, and those cash flowed well.
That is crazy. Dustin, can you share like how setting realistic expectations at the beginning of your journey, how that helps to pave the way to a successful, real estate investing experience?
Well, personally, I found like realistic expectations is everybody's going to have different expectations coming into anything. And so everybody's going to have to really understand my personal perspective as I coach students. It's like, what are your goals? And what are your risk tolerances? You need to know those way before you even care about your expectations. So your goals of how fast do you want to get there? What do you want to do? And how are you actually going to build the business? Now, the biggest thing, so it's not managing expectations, it's actually managing your business. So I'll give you a quick example of how I screwed up. So when I first started investing in 2006, I followed those quote unquote gurus. I went to like this, they said, hey, we're coming to your town with a free 2-hour seminar. I went there and there was a hype and sales pitch. And they said, run to the back. And so I ran to the back and bought another $2,000 course and stuff. It was really, really bad. It was all sales pitch. But what they taught me was what everybody else teaches this, and it's the wrong way. So what they told me really quickly, and I want you to forget it, because when you think about what to do it right, the right way is to build the business. But what they did tell me was you find a property anywhere in the country and then you run the numbers, making sure you're making, $50 a month in passive income. And they said, you're going to get appreciation. Remember, this is 2006 before the crash. And so prices were going up. I'll pause this and say, I don't invest for appreciation. I only invest for passive income. I invest for $250 or more in passive income. Eventually I have 30 plus properties. I didn't need to work. So I'll give these properties to my kids in generational wealth. But with that, the wrong way, they say, run the numbers, make sure you're getting appreciation. Then you spend thousands of dollars to buy the property. Then you spend thousands of dollars to fix up the property. And then you find a tenant, and then you find a property manager. Well, in my opinion, that's just about backwards, because I've had lots of people come to me and say, Dustin, I bought this property, did everything those gurus said, and then I tried to find a property manager, and the property manager would tell me, no, I will not manage that property because I'll get shot there. Well, you no longer have an asset anymore. You have a liability. Instead, and this is the thing, instead of expectations, what we want to look at is building a business. And what I love to tell everybody is we build the business first so that it can run for us rather than us doing the work. And the biggest thing about building the business first, let's say you find the right realtors, inspectors, property managers, plumbers, roofers, insurance agents, mortgage brokers. We find all the experts. The great thing about doing this is you will absolutely have experts telling you how to do it right. In fact, instead of calling up a property manager, say, hey, property manager, I just bought this property, and they say, no, I won't manage it. Instead, you say, property manager, I'm looking to buy this property. Tell me how much it rents for. Tell me, what's the clientele like? What's the vacancy factor? And will you manage it? If they say no, well, then you don't waste the time and money buying that property. But if they say yes, they'll tell you how much it rents for, all the clientele, the vacancy factor. Now you have an expert who literally lives there on the ground telling you how to do it. Because what I wanted to do was I wanted to quit my job, be financially independent. I knew that I needed enough money to cover my expenses. And I remember my wife said it was $4,200. That was, mortgage, insurance, all that sort of stuff. And I realized if I bought one property at $250 a month in passive income, well, that's $3,000 a year without working. 10 properties is $2,500 a month, $30,000 a year without working. 20 properties is $5,000 a month, $60,000 a year without working in passive income. And it was just scaling the business from there. So if you build the business right, you do it first from the beginning, have the experts telling you how to do it, then you just scale the business. In fact, every piece of property that I buy is a piece of inventory that I put into my business. So hopefully that all makes sense, but that's really what you need to do, in my opinion, is build the business so that it runs on its own.
That's gold. How not to get shot. I like that. So let's go to segment 2.